Welcome back to Investing Talk Podcast. Today, we're going to take a close look at Desktop Metal.
Okay, DM.
You sent us quite a bit of information on them. So our mission today is to unpack what's most important for you to understand right now.
Sounds good.
Okay.
Yeah.
We have company overviews, recent performance data, financial health indicators, potential red flags and strengths, market sentiment, details on the competition, and a look at the future. We also have a detailed due diligence report from 2025 covering everything from revenue trends and earnings per share to their market position and potential risks. And to top it all off, we have the very latest developments, including the completion of their acquisition by Nano Dimension just a few days ago.
All right.
So you've given us a lot to work with. Why don't we start by getting a clear picture of who Desktop Metal was before this acquisition? According to the sources, Desktop Metal was a key player in the additive manufacturing or 3D printing industry.
That's right.
They specialized in technologies like binder jetting and digital light processing, offering 3D printers, materials, and software for industries like aerospace, healthcare, and automotive. You mentioned you're trying to get a quick but thorough understanding. Well, they aim to improve manufacturing efficiency and quality in these sectors.
Yeah, that's a great overview. I think it's also interesting to note, Desktop Metal really focused on technologies like binder jetting, which allows for high-speed printing of metal parts,
Okay.
and digital light processing,
Mm-hmm.
which is known for its precision in creating intricate polymer components. So what's really fascinating here is this fundamental goal of making existing manufacturing better.
I see.
It wasn't just about novelty, it was about enhancing how industries operate through additive techniques, and the variety of sectors they targeted also hints at the widespread applicability they envisioned for their innovation.
Okay, that makes sense. So let's look at how their stock has been performing. In the past month, there was a significant surge over 90% on March 25th, 2025. Yeah, that was driven by merger news and advancements in their technology. Over the past 6 months, the stock has been volatile, influenced by financial challenges and those merger developments. But overall, there's been an upward trend due to partnerships and tech improvements. The past years saw fluctuations linked to their financial performance and some regulatory issues. But again, recent merger announcements boosted investor confidence.
Interesting.
What stands out to you so far?
Well, that 90% jump,
Yeah.
that certainly sounds pretty dramatic. But given the previous volatility, what are some potential reasons to be cautious about reading too much into a single day's movement?
Right, because you never know what the next day could bring.
Absolutely. I mean, that kind of sharp upward movement, it certainly gets noticed. It underscores how sensitive the market was to this merger news, suggesting investors anticipated considerable potential or synergy from the combination. However, the longer-term volatility reminds us that their journey wasn't always a smooth climb, and those underlying financial headwinds likely limited consistent growth until the acquisition became more certain. So investors might have been looking at the potential upside, but also aware of the existing challenges.
That stock surge certainly paints an interesting picture. But I think we really need to dig deeper into the underlying financial health to understand if that optimism was fully justified. The report mentions that as of April 1st, 2025, just before the acquisition finalized, the projected revenue for the quarter was $44.1 million, with an estimated earnings per share of negative $0.28. It also points out a negative PE ratio and a high debt-to-equity ratio. That doesn't sound too rosy.
No, not really. I mean, this definitely paints a picture of a company with promising technology, but facing hurdles in reaching profitability. A negative PE ratio inherently means the company wasn't generating profit relative to its stock price, and a high debt-to-equity ratio, stated as 1.57, indicates that a significant portion of their operations was funded through debt, which can create vulnerabilities, especially if revenue growth slows or interest rates increase.
While those indicators look concerning, could there be situations where a high debt-to-equity ratio is strategically advantageous for a company in a growth phase like this?
Well, potentially, but
Yeah.
even with that possibility, the report also mentions some strengths.
Okay.
It highlights their innovative technologies, strategic partnerships, specifically mentioning the earlier proposed Stratasys merger, which ultimately didn't go through, and a strong ability to cover short-term liabilities, noting a current ratio of 2.34.
So how do we balance these positives and negatives?
It's a classic situation of potential not yet fully realized. The innovative technologies and partnerships, those suggest a solid foundation and recognition within the industry. A current ratio above 1 is a positive indicator for meeting immediate financial obligations. However, these strengths hadn't consistently translated into profitability, which is crucial for long-term viability. The fact that they were pursuing strategic moves, like the Stratasys merger, even though it didn't materialize, shows they were actively looking for ways to scale and grow.
That makes sense. So,
Yeah.
shifting to market sentiment, it seems like there was a bit of a roller coaster.
Okay.
Stocks surged on merger news and tech advancements, but there was also cautious optimism online, focusing on the potential of additive manufacturing and those partnerships. It sounds like people saw the promise, but maybe weren't completely sold on the execution yet.
That's a fair assessment. I think the excitement around the technology itself and the potential benefits of strategic combinations is understandable, given the anticipated growth in the additive manufacturing sector. However, the underlying financial concerns, those likely injected a degree of caution into that enthusiasm. Market participants were probably waiting for tangible evidence that these strategic moves would lead to improved financial performance.
Okay, the report also gives us a peek at their competition, Stratasys and 3D Systems. It mentioned that the now completed acquisition by Nano Dimension could enhance their competitive position by combining polymer and metal capabilities. Desktop Metal was known for its industrial scale production, while Stratasys had expertise in polymers. Why is this combination of polymer and metal capabilities considered a major advantage?
Well, the 3D printing market has diverse material needs across various applications. Stratasys' strength in polymers and Desktop Metals in metals meant that a combined entity could potentially serve a broader spectrum of industrial needs.
Okay, so the thinking was that bringing these together would create a stronger player.
Right. This could make them a more attractive one-stop shop for some customers, looking for solutions across different material types, potentially giving them an edge over competitors with more specialized offerings.
And if we connect this to the bigger picture,
Yeah. The 3D printing market is still finding its footing, and companies are trying to develop comprehensive solutions. The initial idea behind the Stratasys combination likely mirrored the eventual outcome with Nano Dimension, building a more versatile portfolio to attract a wider customer base and potentially achieve economies of scale. So now, with Nano Dimension, the focus will likely be on how their specific areas of expertise complement each other in the advanced manufacturing landscape.
okay, looking at the future outlook before the Nano Dimension deal closed, the report pointed to the completion of the Stratasys merger as a potential growth driver, while also highlighting financial sustainability, regulatory challenges, and market competition as key risks.
Yeah, makes sense.
Obviously, the Stratasys part didn't pan out,
Yeah.
but the other risks likely remained. And now we have the Nano Dimension acquisition as the big catalyst.
Right. The risks you mentioned are typical for companies in a rapidly evolving technology space. Maintaining financial stability is always a challenge for firms investing heavily in innovation. Regulatory environments can change and impact operations. And the competitive landscape in a growing sector is constantly evolving with both established players and new entrants. Now, the integration with Nano Dimension introduces a new set of opportunities and hurdles related to merging two distinct organizations. This reminds me of other instances in the tech world where consolidation was seen as a path to broader market reach, though integration challenges always loom large.
The summary recommendation in the report was a hold for Desktop Metal, acknowledging the growth potential, but also the significant financial risks. Given that this was before the Nano Dimension acquisition finalized on April 2nd, 2025, for about $179.3 million, it feels like that hold recommendation has now been overtaken by events.
Yeah, it has.
This all followed a court order for Nano Dimension to finalize the merger, which was initially agreed upon way back in July 2024. That's a long time coming.
It certainly is. The legal aspect adds another layer to the situation. The court order essentially compelled the completion of a deal that had been in discussion for a considerable period, suggesting a strong prior commitment from both sides. This implies that both Desktop Metal and Nano Dimension likely recognize strategic advantages in joining forces, even if there were obstacles to overcome.
Keep in mind that just prior to this, those projections for Desktop Metal's quarterly earnings due on April 1st, 2025, anticipated revenue of $44.1 million and an EPS of animing 11.28 cents, really underscoring those ongoing financial pressures we discussed earlier. The big question now is whether the combined entity, focusing on advanced manufacturing solutions, can finally achieve that financial strength through operational efficiencies and a realignment of their product lines.
That's the central point moving forward.
That's the big bet here, isn't it?
I would say so. Mergers and acquisitions are often driven by the expectation of synergy, the idea that the combined entity will be more powerful than its individual components, in this case. The hope is that by integrating their technologies, customer bases, and operational structures, the new company can achieve greater efficiency, reduce costs, and ultimately become profitable. However, Successfully integrating two companies is rarely guaranteed and presents its own unique set of challenges.
We touched on their competitive landscape, noting key players like Stratasys and 3D Systems. The acquisition by Nano Dimension could potentially enhance their position by broadening their offerings and customer base. However, as with any merger, there are risks involved,
Mhm.
including the successful integration of the two companies
Mhm.
and navigating the broader macroeconomic environment.
That's right.
I mean, we've seen plenty of mergers that looked good on paper but stumbled in the execution.
Absolutely. That's a critical consideration. The potential benefits are evident. But realizing those benefits demands careful planning and effective execution. Combining different company cultures, technologies, and processes can be complex, and any missteps could hinder the anticipated synergies. The overall economic climate also significantly influences the demand for industrial manufacturing solutions.
So to recap, we've seen that Desktop Metal, DM, was operating in a dynamic 3D printing market, with both promising technologies and significant financial hurdles. The recent completion of the acquisition by Nano Dimension on April 2nd, 2025, for about $179.3 million marks a major turning point. This followed a court order for Nano Dimension to finalize the merger agreed upon in July 2024.
Right, and keep in mind that just prior to this, projections for Desktop Metal's quarterly earnings due on April 1st, 2025, anticipated revenue of $44.1 million, and an EPS of -0 toward 28 cents. Highlighting those ongoing financial pressures we discussed earlier, the hope now is that the combined entity, focusing on advanced manufacturing solutions, can achieve financial strength through operational efficiencies and a realignment of their product lines.
We touched on their competitive landscape, noting key players like Stratasys and 3D Systems. The acquisition by Nano Dimension could potentially enhance their position by broadening their offerings and customer base. However, as with any merger, there are risks involved, including the successful integration of the two companies and navigating the broader macroeconomic environment.
The sources suggest a hold recommendation for Desktop Metal prior to the acquisition, acknowledging the growth potential from mergers and technology, but also the significant financial risks. Now that the acquisition is complete, this situation is fundamentally different, and a reassessment will be crucial. This acquisition by Nano Dimension raises an important question for you to consider. How might the strengths of Nano Dimension combined with what Desktop Metal brought to the table reshape the competitive landscape of the additive manufacturing industry? And what new opportunities or challenges might this present for investors in this space?
That is a great question. Be sure to subscribe, like, and comment if you want to explore more about the evolving world of investing.